My name is Will Coleman. I'm the chief antagonist, I guess, here today. And the focus of the panel today is the evolution of energy technology investing models. The context for this panel is a theme that I think you've seen running throughout the summit, which is really the role of corporates in today's energy technology landscape. And as the funding landscape continues to shift around investing in innovative energy technologies, the role of strategics has taken on a more prominent position, which I think everybody here can attest to. The venture capital community drove a tremendous amount of interest in the space, and I think some would argue hype at times. But I think what we've also seen as a result is quite a bit of investment, which has driven a lot of new technologies, new companies, new investing at the research level, programs like ARPA-E, and a lot of opportunities that a lot of the entities here today can talk about investing in. Coming from a venture background, I think it's safe to say that venture's pretty good at vision and passion, but isn't always the most durable form of capital when it comes to supporting companies long term when these waves of interest come and go. And I think that the corporates play a really interesting role in that. And so we're going to talk a little bit about that today. Venture has obviously pulled back a little bit, and I think that's the reality we all have to contend with. But the corporates have shown an interest as they poured into the space in a bit of a afterwave. And I think the question for this panel, and it's on, I think, the minds of many people in the audience, is what role will these corporates play as investors, as partners, and potentially as acquirers as the industry continues to evolve? And the secondary question is, how does this change the way that companies should think about building their companies and what their path to commercialization is? So luckily we have a great mix of folks on the panel today. And so I just want to start with really brief introductions and then dive in. To start, we have Christina Karapataki from Schlumberger. Schlumberger is one of the largest oil field services companies, and in many ways is the conduit for new technology into the oil and gas industry. It also has a host of operations management and networking needs that are pretty similar to other industrial entities. Christina is in the ventures group, and it should be noted that Schlumberger is one of the several companies that has taken multiple approaches to investing in technology, both in-house and also through vehicles such as Synchrony, which sits outside the corporate umbrella but works closely with Schlumberger. Hopefully Christina can comment a bit on both how the internal investing works and then to some degree how their partnerships work. Christina comes from a background in the oil and gas industry and also spent some time at Venrock, which is an early stage venture fund. Next we have Grant Allen from ABB. ABB is one of the world's largest power and automation companies. ABB is also in some ways sort of like Schlumberger, the electric power systems equivalent, which is they're delivering technology solutions to the biggest power providers, as well as something that I didn't realize, which was doing propulsion for large shipping industry partners. They also have a particular focus on developing and acquiring new technology, which I think Grant sits at the nexus of, which is really right between where a lot of the operating groups and the venture group sees new technology. So it'll be really interesting to hear how they balance that inside the venture group. And Grant also has a background in venture through Core Capital Partners and Keystone. Next we have Steve Taub from GE, which is one of the more expansive and multifaceted venture practices or energy investing practices. It really spans everything from direct investing, where Steve is the senior investment director at GE Ventures, through to investments through vehicles like Energy Technology Ventures, which is a partnership between GE, NRG, and ConocoPhillips, which hopefully Steve can talk a little bit about as well. Steve spent a lot of time over the last 7 years at Energy Financial Services, which is really the investing engine at GE and responsible for an enormous amount of the project finance in the renewable energy space and in the energy space in general. So hopefully Steve can talk a little bit about how all these pieces connect together at GE. And lastly, we have Ben Rogers from Broadscale. Broadscale is really an example of how the landscape is changing. It's a response to some of the challenges that these folks and other corporate entities face in terms of making direct investments in early stage technologies or growth stage technologies. Ben joined Broadscale after many years in the energy and power sector. He was at Goldman, and he also spent time with Synergy and Enron. So he's seen it from not only the power development side, but also actually from the M&A side. And I think one of the things that a lot of companies here need to pay attention to is what is the end game? How do we actually get there? And in this new landscape, what will these partners provide? So just to dive in, Christina, let's start with you. So at Schlumberger, let's get some of the table setting here, which is how do you guys think about investing? What stage do you invest? What categories do you focus on? And what are the parameters that you look at in terms of when you're looking at new deals? What are your criteria?
Absolutely. So we started the corporate venture group back in 2008. My investment partner, Ian Cooper, was there since the inception. And there was a conscious decision that we made that we're going to invest in platform technologies. We're going to look for disruptive technologies that we wouldn't have researched in-house, that have multiple applications, but we can also adapt them to oil and gas. So to date, we invested in battery technologies and downhole power, and we're adapting the oil and gas application for high-temperature batteries, while they can also use the technology for other markets. So we followed that philosophy for pretty much all of our portfolio companies. We tend to invest in Series B, Series C companies, so they have proof of concept, they have a prototype that we can test, and then we throw June development money so that we can develop that technology further to a commercial prototype and field testing. Typical investment rounds, 2 to 5 million on the first engagement. We do follow-on rounds as well. And our key principle, we're strategic investors. So we need to have a key application of where we're going to use the technology. We need to have a timeline of how that progression and development is going to happen, and an end goal of commercializing the product. So we always put a product champion that's going to work with the startup and help develop that oil and gas application for us. And we also put joint development agreements along with any of our equity agreements, which is non-dilutive funding for the technology development.
And do you lead as investors?
No, we tend to syndicate. We are always a minority investor, less than 20% equity. All of our investments are with other strong financial investors, and in many cases with other corporates as well, so with other strategics.
Great. Grant, similar question.
ABB Technology Ventures model is strikingly similar. We've been investing since 2010, and this was a group set up inside the corporation to really be a technology scout, to help increase the pace of internal innovation and also hopefully make some money in the process. We've done 13 deals to date, put about $150 million, and we're going to take a pretty split approach, necessitating a strategic angle, but also necessitating a view of the financial deal at hand. We like to deploy $2 to $10 million as an initial bite size. We take a board seat about half the time, and we're coming in typically Series B and later. So I call it expansion stage. We don't like to take a terrific amount of technology risk. About a third of our companies have zero revenue or kind of only pilot revenue. So we can come in pretty early. I think that's important to note. We're not just the company to come talk to when you guys are going sideways or need a huge slug of money. We do like to syndicate most of our deals. Again, we like to get involved with the growth of the company, so that's why we're taking board seats. That's also why the head of our group picked some of us from the venture capital industry. My partner out in Palo Alto came from Draper Fisher Jurvetson. I was with a fund here in D.C. called Core Capital Partners, where I worked actually with Jonathan Silver, who was, I guess, infamous for Solyndra and some of that. But we had a lot of fun investing there, and I actually come from an enterprise software background. So a lot of what we do, I would say, is very much from an enterprise software approach.
Great, thanks. And Steve, you have a little bit of a more complicated mix of things that you participate in, everything from GE Ventures to ETV. And then also, obviously, you consider some of the issues around EFS and how things look downstream. Could you talk a little bit about how those pieces fit together?
Yeah, absolutely. So, as Will said, GE centralized its venture capital efforts into a new entity called GE Ventures that was launched at the beginning of this year. But we've actually been investing in venture stage companies in the energy sector since 2006. Out of a GE capital unit called Energy Financial Services, which has about a $20 billion portfolio of energy assets, power plants, pipelines, oil and gas reserves, wide variety of things all around the world. And so most of the investment team for the energy group at GE Ventures comes out of that background of really, the financial side of things. Our model is very similar to what you heard from Grant and Christina. So we typically invest in Series B and later, although we do occasionally do a Series A investment. And we'll continue to invest in companies through the growth stage. We typically do not take board seats. We like to have observer roles on boards. We feel that allows us to both manage our investments and add a lot of value to the companies. Our check size is typically between $1 and $10 million, and the average is about $3. Since 2006, we've invested in 48 companies. So we've been very active. I think, at least by our count, probably the most active corporate venture investor in the energy sector.
Very active since it was 47 about 2 weeks ago when we spoke.
Exactly.
It's a pretty rapid pace.
Exactly. So, since Will mentioned ETV, let me explain what that is as well. ETV is short for Energy Technology Ventures. It's a joint venture that we formed about 2 years ago with ConocoPhillips and NRG Energy. And the concept there was really from our perspective, to have smart friends with deep pockets who could, help us make better investment decisions and help us add more value to the companies we invested in. And from our partners' perspective, it was a way for them to really kind of accelerate their access to and participation in the whole corporate venture capital world in energy, since we had a much more developed and active platform than they did at the time. And so that's worked out very well. That's actually our primary investment vehicle these days for energy. Under certain circumstances, all three of the partners can invest outside of ETV, but generally speaking, we like to do things through ETV when it makes sense to do so.
And investment for ETV can come in through any of your partners, and that decision process is a joint process, or is that a decision process that is individual to those companies?
Yeah, the decision process is complicated, and I don't want to get into the nitty-gritty of how it works, but it's a collaborative process among all three of the partners, and deals get sourced by all three of the partners, at different times.
Great. To extend on the complexity of GE, actually, Broadscale is a partner of GE's as well, doing investments in growth stage companies. So, Ben, maybe you could talk a little bit about what the model is and what you're responding to in terms of the model and these criteria.
Yes, so we're slightly different than these guys. We don't have the balance sheets of these guys. But this is a new type of an investment firm where we're putting together a global network of leading energy companies, specifically focused on the commercialization of companies. And what that really means is we're very focused on bringing kind of a customer-centric approach to push, pulling through technologies through this maze of the scale-up process. As Will mentioned, we're just starting out. We launched last year. We have GE as a great partner. We have Duke Energy, and we have National Grid. We are very much utility-centric focused, and so a lot of the companies that are here have to go through the utility to get to the end user, the customer. And so our focus as a investment firm or commercialization platform or merchant bank, there's a lot of different terminology for it, but it's somewhat of a combination of an advisory role as well as an investing partner. And so having a network where growth companies can go to get access or faster access to strategics and utilities is our approach. And so it's one where, with my background in finance and utilities, is very much focused on how do we make this process easier to get to the end user. How do we actually focus on this valley of death or this commercialization gap to get the growth companies to have faster access to the right people at these companies, actually, as well as the utilities, and then also help the growth companies work through the maze of the utilities in terms of how do we go from pilot to scale. So there's a lot of organizations that help go from lab bench to demo, but there's no one organization that focuses on demo to scale. So all these companies are out there trying to, work with venture capital or private equity or incubators or strategics. We're trying to figure out how to have a utility-centric clearinghouse where that growth companies can go to get faster access to scale up.
Yeah, great. So the theme of the day is that venture is pulled back somewhat, and there's a bit of a gap there, and that strategics are pouring in. I think we've heard that throughout the halls. Is that true? Are you seeing more and more activity from corporates? And if so, what do you think is driving that today?
I mean, just some statistics that I was reading the other day, there are 550 corporate venture groups to date, and the majority of them are less than 3 years old. So there is a huge activity. Huge multinationals were branding their activities. Maybe they had outsourced venture activities and now they're bringing it in-house for more control of the technology. So I think the strategics are moving in and playing a role. And it was 13% of the deals last year that had strategics involved in any kind of venture-backed deal. So I think there is a role to play, especially for technologies where you need large development funds or large funds for field testing, where strategic can contribute towards that.
I'm sorry. From my perspective, I do think that we have seen somewhat of a pullback by the institutional venture funds, and we do see more activity on the corporate side. But there's also been a bit of a game of musical chairs going on the institutional side. So you've had funds pull back, you've had new funds raised, and in some cases you have some of the same individuals have left one firm and gone to a different firm. So I think the pullback is real, but I think it's maybe a little bit overstated.
And one of the things I would comment on is that this industry is highly capital intensive. What we like to say is there's no two guys in a garage creating energy storage or energy efficiency, or it's just too difficult. So you need to have partners to get to scale faster. And so it's because it's capital intensive, because you're going through utilities. Utilities, as we know, are risk averse. They have regulators to deal with, so they have to go through sometimes the Public Utility Commission. And it takes a longer pilot process to get things kind of scaled up and put on the grid. And so I think it's, you need large strategics to be able to have capital for 5, 7, 10-year periods of time.
The data prove out that the pullback of VC is real, and this is at a meta level, not just energy. And the role of strategics is increasing importance, and again, not just in energy. The CVC data is showing a huge increase across, from BMW to other car manufacturers to other industries that are less capital intensive than we are. But the role of the strategics going forward, I think, is just going to become more pronounced. There's a reason I left an institutional venture fund and came to a place that has $5 billion in cash behind it. And we can act in a very different way and add value very markedly and very, very fast.
What do you think the key drivers are inside those organizations? Why now? Is it because there's a proliferation of opportunities that have come out of the first wave and you see an opportunity there to go and get in these companies? Is it because the landscape is now situated and therefore it's a more stable environment to go out there and invest in these technologies? What is it that's driving the interest today?
By corporates in this space? Without going into a lot of detail around the way that innovation occurs inside companies, which I think a lot of companies are figuring out, including ABB, you have to, by definition, have a technology scout thinking about things. Of course, we also have our 7 corporate research centers. We have a huge billions and billions of dollars going into R&D. We have M&A function, and our new CEO, Joe Hogan, has been very acquisitive, acquiring 3 companies over $1 billion. But we are there to be the technology scouts, open up the eyes of our business units, and also to feed the M&A pipeline. And we actually just acquired, at the ABB parent level, one of the companies that I had invested in 19 months ago. So we've already proven out the model of investing in a company that will later become an acquisition by the ABB parent. So we're touching all those different areas of innovation. I think that it just feeds the machine.
From my perspective, I think it's a search for growth and competitive advantage. In a company the size of GE, you need to add tens of billions of dollars a year in revenue just to maintain the growth rate that the market is expecting from you, and that's pretty challenging. And so, working with venture-backed startups and these small companies, they may not have the horsepower to commercialize some of the things that they invent, but a company like a GE or an ABB or a Schlumberger working with them, can really take those technologies that, have been incubated in the lab and they've been demonstrated maybe at a small scale and really take them worldwide. And I think that's the main driver.
Yeah. So the venture model was always premised on building these large standalone companies that would come into a marketplace and likely compete with big strategic incumbents. But this is different, right? And I think in the energy space in particular, we saw even the venture model was premised on a lot of partnering going on with corporate partners downstream. As investment continues to come in from strategics, how do we think about what that means for the kinds of investments that will get done? And so how much alignment is required for you with your operating divisions? And in terms of that alignment, how do you evaluate that early at the stage that you're getting in?
With Schlumberger, we get our technical team involved with the startup as quickly as possible. So we need to make sure that we have a good fit between the product that the startup is offering and how can we leverage value both from the internal R&D and their knowledge how to promote the product quickly. And we have a 3 to 5 year timeline for commercialization for our joint development agreements. So we try and ensure that there's alignment very quickly. We get them in touch with the technical team as soon as possible, on-site meetings, and unless there's some good chemistry going on with the engineers who are going to be working on this project for 3 years, then that could mean that we can't go forward.
Right. And how much is it a requirement that there's an acquisition opportunity at the end of the day?
For us, it's not a requirement at all. We try and look for these platform technologies where we use it for oil and gas, but they can grow in their other markets, and we want them to grow because we're also an equity stakeholder. So we don't see acquisition as the end of the line. We did end up acquiring 2 of our 14 portfolio companies, but that wasn't the target. Most of our companies have IPO at the end because they want to leverage all the applications that they can exploit.
Okay, but you might take a partnership or some sort of exclusive partnership associated with a product.
Yeah, but usually we do have some exclusivity requirements for a specific application. But because they're platform, we're trying not to limit them. So it might be exclusive of the oil field, but easy to use in the electric cars and smart grid and applications.
Is it similar for the rest of you?
We do not have a requirement to have a BU specifically sign up or sign any sort of agreement locking them into being involved with the company. But during diligence, we are certainly going to the different business units or technology groups and of relevance to the company and getting them deeply involved with the technical diligence and often striking a commercial agreement for preferred distribution or something like that. We're never going to ask for anything crazy like a right of first refusal in the term sheet or anything like that, but we're going to act as your advocate if you're working with us and we're investing in you. To effectively give you a hunting license to then go around the company and broker business much as you would with any other third party. But we will make sure that's done well in advance. And so I'm already trying to get companies that I know will be up for investment in, say, a year and have them talk to the relevant business units. And so if they need to start integrating around one of our piece of power electronics, they can do that. So then when it comes time to invest, I've already got that box checked. And I can think of it solely as, will this be an attractive financial investment for ABB? And it doesn't necessarily have to be an acquisition later. Maybe some of them will. I hope more of them will. But I'd just as rather have one of our companies be sold to GE. That's the best outcome for the company. Right. I mean, we have to satisfy both sides of the house, strategic and financial.
Right.
Yeah. Once again, our approach is very similar to what Grant does. We like to have the companies we invest in have business relationships with the different units of GE, and we identify a lot of those opportunities through due diligence. And again, we're not asking for rights of first refusal or anything like that. GE has yet to acquire any of the 48 companies that we've invested in, although there have been a number of companies that we've introduced to the business units that wound up acquiring them. And there have been a couple of swings and misses from the GE side on making acquisitions, but hasn't happened yet. But I think the other thing to keep in mind is, we're not just talking about technologies that investing in technologies that our companies would want to own, right? So we may be investing in a company that could be a very important supplier, for example, or a customer, or a channel to market, a business partner in some way. And it doesn't necessarily make sense for you to actually own those at the end of the day. They can actually be more valuable sometimes as independent partners.
And that's what we talk about. I mean, obviously it's just not capital. We want distribution, operational expertise. We want ability to do JVs. Some of the companies that we've looked at, on the energy storage side, ABB can supply parts. And so it's figuring out for the growth company, how can they grow, scale up faster with all the other, products and services that these companies have, because it's never just about capital. It's about how we have channel partners to get to market to sell that product faster. And that's what we try and align the growth companies with the big strategics.
And are there specific kinds of companies that you think would sit more naturally under the umbrella of Broadscale than sitting inside of a strategic early on?
That's a great question. We're as a new company, we're starting to figure out, based off where their growth is, what type of product it is. Is it a large $50 million energy storage technology, or is it, are you selling products, energy efficiency products? I mean, so it all depends on where they are in their pilot stage or development. And it also just depends on where they are in terms of their need for capital or versus need for partners.
Great. So, I mean, I think you all mentioned that you invest in companies both for strategic alignment and actually for as standalone businesses. But I think as the landscape shifts a little bit more and you see corporate dollars driving a lot of these investments, I think the traditional model that venture espouses, which is proof of concept, pilot, demo, scale with a partner, and then go IPO, may or may not hold over the long term. What that means is that these companies probably have to think differently about how they build their companies and what their roadmaps look like. So when you're thinking about what the requirements are to invest in a company, how do you think this is going to impact the way these companies should think about their planning and what kinds of milestones they should prioritize when they're coming in to meet with folks like yourselves and trying to anticipate what the needs of a corporate partner would be as an early investor?
I mean, for us, and I think this is very specific for every corporate group in terms of how they're going to look at it. But for us, the first step is always the technology development. And if they can relate with how they can be helped with a multinational like Schlumberger. So is there a need for field testing that we can accelerate? Is there technology synergies that we can leverage from both companies to accelerate the products? So I think for us, even as the landscape is changing, that will be the key factor, the first assessment that we do. And pretty much 80% of our due diligence in terms of looking at the technical side and where is the value and how does it fit within our corporation. And also figuring out if there is a match between the cultures of the startup and our engineers, which is always a clash.
I like the quote this morning. There was, a vision without resources is a hallucination. So we hope to be there to provide those resources. And just as one data point, we were, in terms of milestones and where we come in, asked to wait on the sidelines for a company. They said, no, we're not ready to have a strategic. We want to wait and basically bring you in when we need to build a big, expensive plant. That's their prerogative. They can wait and talk to us when they want, but we decided to pass at that point. We need to come in early. And we want to participate in the growth of the company and not come in when valuations are inflated and we can't get meaningful ownership. I mean, maybe the criteria are obviously different for every company, but I think there should be enough of a pattern out in the market of corporates adding a lot of value, giving you the brand stamp, giving you channel access, allowing you to sell in industries that you would never otherwise be able to sell into because there's too much fear that you as a fly-by-night operation, as a startup, may not be around 10, 20, 30 years down the road when a utility needs to have you around. So I hope that, again, there's enough pattern out there in the market to know that you can talk to us earlier than your board may say you can, and to start that discussion.
Mm-hmm. So one of the classical critiques of strategics has been that I think when people envision the animal that the strategics best represent, it's probably not a gazelle, it's probably more of a gorilla or something a little bit slower moving and heavier in mass. But how do you respond to that? Is that a fair criticism? What does the timing look like for you in terms of doing a deal? Maybe give a couple examples of deals that have taken a long time and deals that have taken much less time. Steve, maybe you want to start.
Yeah. So I mean, look, there is some truth to the idea that strategic investors typically are a little bit slower. Some of that is frankly because we have different approval processes that just take longer to get through. Some of it is also the sort of the depth of the due diligence that we do on things like technology. It does take additional time. But it's interesting to think about examples. So we have one example that I can think of where we're still actually waiting to actually close and fund is actually being held up mostly because the company is simultaneously raising some debt, and so our equity won't actually fund into the company until the debt gets closed, and that's really what's been the long tent in the pole, the long pole in the tent. Sorry. In terms of the timing of that, and this is a company that we've been kind of hanging around now for probably 2 years, and actually kind of have an investment commitment contingent on this this debt financing that's been kind of waiting around now for several months as they try to get that lined up. So maybe that's kind of one extreme. I guess on the opposite end of that extreme, we ran the Eco-Imagination Challenge for GE a couple of years ago, and out of that program, we invested in I don't know the exact number, probably 17 or 18 companies out of that program over the course of about a year and a half. And so you can imagine some of those went through fairly quickly as a result.
Yeah.
Our average is probably 6 months.
6 months. From first intro to close.
Yeah, there is some truth that it usually can take longer than a financial VC, but I think something very important with a startup is to realize very quickly who the key decision makers are. And for every CVC group, it's probably going to be different, but is it the engineering team that's going to fall in love with the potential of the project and the value and be able to prove how they can use that technology and sell it? Is it the investment team? Is it the investment committee? Is it the M&A managers, key executives in the company? Who is it along that chain that you need to convince as a CEO of a startup? And be able to move fastly through the process that any multinational has by being able to target the right people in that process.
Yeah. And what can they do to anticipate that and to do that targeting the right way? Is there anything a startup can do that's brilliant insight into the way Schlumberger works?
Yeah, I mean, there's the early stage group that we have contacts with all the segments and all the project development groups. We do one visit per year to all 7 of our research centers. So we try and be as much plugged into the technology needs of the company as possible. So we could direct you and make that first intro to the right engineering group that will get excited about your technology. And specifically for Schlumberger, it's if you convince the engineering team that you can add value with your product, that's the biggest step that you can, biggest box you can check.
Yeah, I just wanted to make a point. I mean, so as I said earlier, a lot of the time the timing depends in part on some of the level of due diligence that we do. But of course, at the end of the day, that's one of the reasons that people want to have corporate investors and strategic investors in the first place, is because it does, I think, is perceived as conferring kind of an endorsement, but that endorsement, we don't give that lightly. We have to do our due diligence, and we have tremendous technical expertise that we can bring to bear and tremendous market knowledge we can bring to bear, but it does take time in order to make that happen.
The way I look at it in my old world, it was a team had flipped 3 companies, maybe sold one to Facebook, and they're developing a new iPhone app. Well, you can tell pretty quickly if it's something you think meets a market pain point. What we're doing, we may run a full test on an electromotor and verify it with some of our corporate research guys. That takes a long time to set up the test, allocate resources, get results back, then maybe talk to the financial VC that we're dealing with. So by nature, just the technical diligence that we're doing, you're adding 2-3 months at least to the process. In terms of our actual approval process, it's actually very fast. We've already typically vetted it with our executive committee, and for follow-ons, it can be literally over email. But we do, I think, work very closely with syndicate partners to make sure all the diligence is done up front.
The only comment that I would add to that is that what we try and do is have the growth company become a more informed kind of customer, so to speak. And so if they understand kind of the path to getting this investment, and they understand how long it takes, maybe on their side they can better manage their monthly burn rate, so that they're managing capital appropriately in terms of how long it could take for this milestone to happen or that milestone to happen. So we're kind of using capital more efficiently if you understand the pathway to development.
It kind of gets back to something Grant said earlier, which is that it's, even if there isn't an imminent kind of fundraising going on, it's often really worthwhile to go out and build those relationships and make sure that the strategics that you think might be interesting investors are up to speed, familiar with what you're doing, because that way we can, when the time does come for an investment, we can be a lot faster because we've already kind of gotten through some of that diligence.
And we've had that situation before where there's a hot company and they're having the rounds in Sand Hill Road. They say, ABB would have been a fantastic partner, but we can't act as quickly as Raylene at KPCB or Coastal Ventures or something.
We had one situation now I think about 2 years ago where as you say, one of those hot companies, and literally they kind of gave the introductory pitch, and then they said, okay, you've got let us know by tomorrow afternoon if you want to make an investment commitment. And so that was an easy answer. No, we can't do that.
Yeah. So we're going to get to questions in a second, although I don't think we have an internet connection on this, so if somebody could come and set this up, that would be great. Before we do, I want to ask one question about what would make you get out of your chair and sort of run for an opportunity. You've probably seen a lot of things here today, but you also probably have your own hunting list and things that you would love to see and things you don't see enough of. So I'd love to just hear maybe one or two things that you're hoping to see either here or out in the world these days.
Well, for us, we operate in a fairly harsh environment, high temperature, high pressure, a lot of vibration and abrasion equipment. So, what is usually number one on our list is high temperature materials, high temperature electronics, any stimulation techniques or chemicals or adsorbent materials that can operate at those conditions. That's kind of what would make us jump. And
I thought you meant at a meta level, like Elon Musk telling me to invest.
Well, you can answer the question however you like, but I think these people would appreciate a specific.
A little more tactical. Right now we're looking at, I think, the next wave of clean tech, which is much more around energy technologies, using software to drive efficiency, performance improvement, and really act as the control layer and the security layer on top of the infrastructure ABB already sells. We sell a lot of widgets. Some are very, very large widgets, but effectively it's a lot of hardware with some embedded firmware as well. But we are very much in need of innovative companies to add control systems on top of that. One area is asset health management, condition monitoring, and actually looking at all of these end loads, whether it's a big turbine that GE sells or a big drive system, electromotor that ABB sells, and looking at data coming out of that, making sense of it, having an alerting system to let operators know if it's going to break soon. And the extension of that is actually looking at some of these resources as driving demand response and thinking about a centralized DRMS. And there's some companies here that are trying to push towards that kind of sensor agnostic DRMS setup. It might be cloud-based, it might be on-premise, but thinking through how we deal with those large amounts of data, how we make sense of them, how we drive very quick, meaningful analytics, extracting more signal from the noise that's coming out of all these end devices.
I think one of the things that we've been really looking for is big data kind of opportunities in the energy sector. If people were here this morning, you might have seen the discussion with Bill Rue, who runs GE's software initiative, and he was talking about how just the massive amounts of data that come off of all the equipment, all the machinery that GE supplies around the world, and we would love to find technologies to take that data and generate productivity improvements for our customers. Uptime, efficiency, whatever those things are, even a 1% increase in productivity has tremendous value for us and our customers.
Yeah. We live in a world very much of incrementalism. I mean, we don't see that much true disruption in our industry. So if we can shave a couple performance points off some of our existing equipment, that is hugely meaningful, whether it's an efficiency gain or performance gain. So those little niche technologies will seemingly niche across a lot of our products, GE, ABB, Schlumberger, actually make a lot of difference.
Yeah. What we do is we listen to our customers, and so we go out and proactively talk with Duke Energy, National Grid, other utilities to see what they're focused on, and then go out and seek out those type of technologies. What those utilities are really focused on are system hardening technologies. Obviously, after Sandy, that's become a much bigger issue. It could be a regulated type of system hardening, or it can also be merchant. Microgrids is a key area of focus for many utilities. Obviously, energy storage is always a key focus. Data is also a key focus from what we hear from the utilities. And so that's kind of where our area of expertise is facilitating those areas. So again, kind of speed to market mentality and focus on how do you structure, how do you commercialize, how do you originate these types of areas for your customers.
Great. So going to the audience questions, I noticed there's a handful here that are very logistical, which maybe I'll bundle together and you guys can answer as appropriate. But it's echoing a little bit something that was said yesterday on the strategic panel, which is concern about IP. So one of the first questions is, are strategics more interested in IP than the venture world? When technical teams work with venture-funded businesses, I assume that means corporate venture-funded businesses, who owns the IP? There's a couple other questions about when do you sign NDAs, and what are your expectations around ownership of IP?
So I can tell you a little bit about how we think about this, and this is something we actually pay a lot of attention to, because if you have a miss on, managing IP, especially third-party IP, you're done. So it's very important to us. We do sign NDAs with companies that we're considering investments in, but not for a first conversation. It's just not practical. So we figure we probably see 1,000 companies a year, and we'll have introductory discussions with a couple of hundred. We can't sign 300-400 NDAs a year. We'd be doing nothing but that. We will sign an NDA to when it's appropriate, but it's usually we want to sign a few dozen a year, not a few hundred. We are very careful about tapping into the right experts at our global research organization and other parts of the company. That we'll bring them under those NDAs, and that means that we have to recognize that we, and I'm sure you folks too, have we will have programs within our companies that are working on similar or potentially competing technology. Yeah. So we have to be careful about who we actually bring in under those NDAs. We look for experts that have the right expertise and the right market knowledge, but aren't directly working on those areas. So you can manage it that way. And typically, when you get into a collaboration of some sort, typically the way it works is, you own your background IP, and we own ours, and any IP that gets created as in the process of the collaboration is going to be kind of jointly owned in some way. We'll have, we'll license, cross-license any IP that we create. That's kind of a typical way to set it up.
Yeah. Is that similar to ABB?
Very similar. We were very upfront, both reputationally and because of how we structure our NDAs, which we do sign a lot of them, that the IP does stay with the company. And whatever fear the company has, we can solve for that in a lot of different ways. I think the only time it really becomes tricky is, like you said, when we're already working on some area inside the company and we have 10 PhDs drilling down on some specific thing, we find a company doing something similar, yet we want to vet it with the experts doing that. Mm-hmm. So we have to usually pick someone who's maybe tangential to them or kind of adjacent to them, have them advise, give us an indication of how good it is, whether it's synergistic to what we're already working on or competitive, and then we can take it from there. But we are very good about keeping that Chinese wall in place if it needs to be.
Yeah. We're extremely similar. We sign NDAs as well, usually at the point where we have a site visit scheduled. That's where we're going to put an NDA to have a useful discussion. And then we avoid this contamination of IP issue by having the investment group which act as the middleman between the startup and the internal organization to avoid those issues.
Ben, I imagine this is similar for you. You're sitting there as a buffer to some degree between the corporate investors and the entity itself, right? So is that something that you think intensely about?
We don't have the same experience as these guys. We're advising the growth company on how to go to market in terms of after they've hit pilot. So we're doing our own due diligence there. And then obviously we're working with our network members to make sure there's an exact fit there, so that they can kind of scale up faster. And so our approach is a little different, where we're kind of really looking at how do we create demand, how do we create a market, or where is there the right market fit for this technology. So it's a little bit different.
Yeah. So I think I was a little hard on venture, because there's a couple questions here about the role of venture going forward. Specifically, is there any role for institutional venture anymore if strategic partners have financial resources, patience, and technical depth? Maybe you could pair that a little bit with the next question, which is, are there any other emerging investment models that you've seen other than corporate venture and traditional VC for early stage companies?
You see energy companies on AngelList. Those platforms do extend to energy, even as geeky as some of the stuff we look at is. So I think you'll continue to see some of those high net worths and fully codified angels and people out there playing angel, I use that term pretty loosely, dipping their toes in the energy space, especially as we move into efficiency analytics and some of the more software heavy plays in Intertech.
Yeah, absolutely. I think so. For capital efficient opportunities like in software, for example, I think angels will play a bigger role. I think, for more capital intensive, I think it's more going to be, organizations like ARPA-E and the Department of Energy that have grant money. And from my perspective, is there a role for venture capital? Absolutely. We are always investing alongside institutional venture capital funds. I think I said earlier, we don't take board seats, but I want to have somebody who does have a board seat, who has the same economics, the same incentives, and that we have, who's going to represent our interests with the company. There's a lot of things that the corporate venture folks do that we have a hard time doing. We very rarely lead a deal, so we are typically looking for the corporate venture, the institutional venture funds to source deals and bring us, here's not just a company, but here's the term sheet, here's the valuation, we're going to take a seat on the board, we'd like you to be part of the syndicate. So from our perspective, it's crucially important actually to have those funds.
This industry is so capital intensive. You need as much capital as possible, and you need it from every part of the value chain. And so obviously from a risk reward perspective, there are the riskier type investments that you're going to make earlier on. And as you kind of hit your milestones and scale up and do the right things you need to do, then there's other type of investors that come in at that point in time. But you need capital every single part of the value chain.
Yeah, and you all mentioned that you're pretty much investing at Series B or later. Is that thinking evolving inside of your entities? Is there, as perhaps there's a little bit of a challenge in terms of sourcing as venture pulls back a little bit from Series A? Or are you seeing plenty of deal flow coming from the venture community still? How do you think about that gap there in the Series A period?
Definitely no shortage of deal flow. That's, we haven't seen that lately. But we have had the exceptions to the rule. We've invested earlier, and that's usually technologies that come through our research collaborations that might be extremely interesting because of their innovation. So that's a case where we're going to go earlier and invest in even a seed round. And two of our portfolio companies, again, fall in that category. We have one that went to the growth stage, Series D, again, because it was so disruptive and innovative that we needed to have a piece of it. But the majority of where we lie is typically VC.
Yeah, I personally see us moving a bit to a bifurcation. We'll do some earlier stage deals, smaller amounts of capital. We've actually written a check as small as $250K. And I think to actually sprinkle a few more bets out there exposes us to a lot more technology, which serves the role of us being technology scout. So I would frankly like to see that happen. I think it will over the next year. We're certainly, without a doubt, going to be more active in 2013 than we were in 2012. But I also see us coming in and playing, a big role in those Series C, Series D type deals, where you need someone coming in to write, $20 million plus check. We've gone up to $25 million, and like I said, I think you'll see that divergence. Right now, we're looking at a deal that will be led by a financial VC in the condition monitoring space, and have 3 strategics very likely behind it. And that's an opportune situation where the deal terms are being set by the financial VC. Keep back from that, and it allows us to distance ourselves from having those conversations with the company too soon. And I think it's very good for the company because when it comes time to sell, you're not wedded to any individual strategic. Yeah. You can actually have the benefit of working with all these different strategics, but not have it, optically out in the market that you've wedded yourself with one company.
And are these strategics in different places in the value chain, or are they competitive strategics?
I would say we are selective. Yeah. There's a few, and we've done a deal with GE. There's a few that I guess have heightened sensitivity inside ADV. You can probably guess who those companies are. But generally, we do like to pick strategics from different parts of the ecosystem that add different values. We certainly like to have other strategics in the deals that we invest in too. We've done deals with ABB, with Alstom and Schneider and Siemens and lots of other strategics. From our perspective, we understand the value that strategic investors can bring, and we don't have the bandwidth to do everything. So we like the idea of having multiple shots on goal to actually deliver strategic value. In terms of where we would play stage-wise, we do occasionally do Series A investments. I think out of the 48 companies, I think we've done 4 or 5, where our first investment was in a Series A. So we do it occasionally when in the right situation. I don't think we're going to materially increase that number, to be honest. Series B just has the sort of the right
the right feel for us in terms of the risk reward trade-off, and helps mitigate some of the other concerns, like IP, for example, where by the time you get to a Series B, you've got your patents well underway and things like that.
And we've talked about this before. I mean, how much technology risk do we really want to take? I mean, we've certainly gone into companies that don't have revenue yet, but that's not something we're exactly looking for.
So as a parting question in our few seconds of overtime here, any words of advice for young companies who are seeking strategic investment?
Go down. My only advice is to engage us in dialogue as soon as you can. We're here to be ready partners, and I think the sooner you can expose us to your technology, start integrating with our different business units, and have that dialogue with us, I think the better we'll be equipped to invest in you and help grow the company down the line.
Start engaging early, even if you don't need the funds today. And also the second point was try and understand exactly where your value is within this huge, monstrous multinational. Because it's very hard to identify the right people in the right group that will actually pursue your technology, and that takes a long time. So be wary of that timeline until you find the key person.
So early and anticipate, basically. Well, thank you very much. We're over time. Please help me in thanking the panel for a great session.